Hello everyone, Dave Landry here from DaveLandry.com. This is episode 28 of Trading Simplified. So what are we going to talk about? Well, I want to continue my discussion on 12 plus 1 trading rules, and this is part 3. We might have to go one or two more episodes on this based on the nature of the overall market. So speaking of the market, I want to do a bear market update real quick. Some of the things I'm seeing, some of the things that are happening, and quite a few other thoughts, and you'll see that in just one second. And of course, look at the charts. Now, housekeeping, I do take requests. I did have a request last week to explain more about entries and protective stops and exits. What I would encourage you to do, because it's going to take me a few weeks before we can get back to money management and other topics, is to go in and watch previous shows where I did talk about money management. And if you're in a big hurry, I would encourage you to go in and take the money management module under the members area. You do have to be a gold member of DaveLandry.com for that. If you need to reach me, DaveLandry.com/contact. If you would like the slides from this show and every other show, that's 27 shows so far, then just put your name in at DaveLandry.com/StockCharts, and I'll send you a plethora of information, including the slides from this show and all the other shows. And that way you'll have all the rules to all of the systems that I have discussed. Now, I've been doing bear market updates based on the nature of this market. The latest one is the rally could continue, but I wouldn't bet my house on it. And that'll make a lot more sense after you read it. I encourage you to go to my website, DaveLandry.com, and read it. So some of the following information came from that article. So if you get a chance, or if you can't sleep at night, read that article on my website. So in that article, I discussed Retail Mania. Now, Retail Mania comes from a report, or I should say a tweet, that Citron Research put out. And what happened was I got short a stock. It's the mystery stock, and I'm still short, and it's been very painful so far. But after I got short, I do ignore the news, but every now and then I get a little bit through osmosis. And I noticed they had a report on how this company was a fraud, GSX, that is. But so far, the market doesn't care about Citron Research or my position. But anyway, poking around their website, I noticed some of their tweets where they were looking to sort of flesh out some of these other companies that might be frauds or fraudulent activity, I should say. And what happened was a lot of these stocks are going up, and that's because, in their opinion at least, a lot of these freshly minted retail traders are going in and buying a lot of these stocks based on hope and stories, or so-called story stocks, and they called it Retail Mania. Now, Retail Mania has caused me to drop a lot of F-bombs in a lot of my shorts. I'll have to keep from crying. So they are wreaking havoc on my shorts, so I might be a little bit biased against them. Now, what's interesting is, as I told the story in the article, without going into a lot of details, my contractor for my house and office, he saw me on the front porch about a week or so ago, and he started asking me questions about trading because he's doing the wood next door. And he's interested in trading because some of his friends are making money trading. Anyway, long story endless, I called him up to get some materials for a honeydew project, and he told me that one of his friends had mortgaged his house in order to fund his trading account, and this guy just started trading. So even though this rally has been fantastic, if you're new to trading, I'd love to have you, but just remember that the market doesn't always just go up, and obviously we just had a 30% slide that happened over a very quick period of time. And my concern for somebody like this gentleman who just ran out and mortgaged his house would be that if this market would roll back over, he would be in a world of hurt really quick, especially since I'd be willing to bet most of these newly minted traders, these traders who are bored in quarantine and decide to start trading, don't have a money management plan in place. So again, if you are new to trading, this is what this show is all about, or at least you're one of our main people that we're trying to reach here, those who are new to trading and those who have maybe been trading a lot longer and want to simplify things and bring them back to their utmost essence. So just don't bet the farm or your house on trading. Now, we're not going to be able to get to money management today, but we have gone through money management quite a bit in the past. And again, I do have a module that focuses just on money management, which is free to members, but you do have to be a member. Anyway, money management, money management, money management, and I'm going to, spoiler alert, give you those three. Those are three of the rules. Money management, money management, money management. It's like location, 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 obviously to real estate. Now, my big question, again, is what's going to happen when this party is over? And again, in this article, without reading the whole article to you, part of my concern, and maybe I am confusing the issue a little bit with facts, is that this rally is based in part upon this liquidity and the government pumping money into the market. And I don't want to claim to be an economist because I'm far from it. And, an economist will tell you tomorrow why what they predicted yesterday didn't come true today. And I guess people could say that about me, especially since I've been so bearish lately. So I shouldn't pick on anybody in their profession, but that's an old economist joke. And they, too, even say that about each other. I actually learned that joke or saying from an economist. So the bottom line is I don't want to confuse the issue with facts. If the market is going up as a trend follower, then the market is going up. But I do have some concerns, and some of those concerns are based on the charts. So let's take a look at what the charts are saying. Now, there are some conflicting signals between the shorter term signals and the longer term signals. So here we have a daily chart, and we have the well-watched 50-day moving average. Now, I don't do a lot of analysis with the 50-day moving average because I think it's something that only matters when it matters. When the market begins to weaken, I start paying attention to it. And then when the market begins to strengthen, like it has lately, I begin paying attention to it again. But there are some interesting longer-term relationships that are kind of cool. For instance, Landry light, meaning that the lows are greater than the moving average, can be useful to help keep you on the right side of the market. So you can see we had this nice little run here. And during that whole run, there was Landry light. Now on the bottom, and I keep teasing this indicator, but I actually don't use it a lot other than for teaching purposes or just occasionally do a little research with it. But basically, we're just counting the number of days that the market has had Landry light. In other words, every day the low is greater than the moving average counts as +1, and then when it intersects or crosses below the moving average, then it gets reset to 0. But as a general statement, if you stay long when it's green, and if you stay short when it's red, and it's red when the highs are less than the moving average, in this case we're using a 50-day moving average, then as a general statement, you will stay on the right side of the market. Now, it's not a perfect indicator, obviously, but it is something to help keep you on the right side of the market. Now, recently, if you squint your eyes, you can see that it did turn from red to green because the low of the S&P 500 is greater than the 50-day moving average. So we're going to have to pay attention to this indicator. Obviously, it's improving. One thing that concerns me quite a bit about this market is we are overbought in here. And again, not to confuse the issue with facts, but I think a lot of this rally can be attributed to a new influx of retail traders in addition to the government pumping money into the system. But let's not confuse issue with facts too much and just pay attention to what the charts are saying. So over the short term, at least going back several weeks, obviously the trend remains up. However, longer term, a little bit different picture here. And once again, you could see on a weekly basis, the indicator using the 50-week moving average, and this is a weekly chart, stayed green for a long time. And it turned red during a spill back in 2018. Now, that doesn't look like a huge slide, but that was a pretty big slide. In fact, if you held on to your longs, unless it was a really great long and didn't stop out, obviously, but if you held on to your longs just blindly through that, I think that was a big mistake. And that's one of the other market updates I did was called The Man on the Street as a Microcosm. I like to listen to the man on the street to see what he's thinking. Kind of like the Shoeshine Boy indicator back in the day when the Shoeshine Boy would start giving you tips in the stock market. I'm not quite that old. I'm old, but I'm not quite that old. But if you read some of these old classic books on technical analysis and stock in the stock market, they'll mention the Shoeshine Boy. And that's kind of where we are once again, but this time it's the quarantine traders. Anyway, getting back to the Landry light, you could see, other than the little kiss that we had back in the middle of 2019, there was mostly upside Landry light. Now, I might have said 2019 the slide. That was actually December of 2018 that we had that big slide in the overall market. Now, speaking of big slides, we're obviously back in a big slide now. And you can see we have downside Landry light in the weekly S&P 500. Landry light being that the highs are less than the 50-week moving average. And by the way, one thing I talked about last week is the longer it stays green, the more likely the market will continue to stay green, and the longer it stays red, the more likely the market will continue to stay red. Sometimes you get a big old do-over where market slides, comes right back, and the market just keeps on keeping on. People don't have time to begin to adjust to the market at lower levels. And everything I do has a psychological backing, and if you think about it, if this indicator stays red for a while, meaning that the market is negative or at least lower than where it was, then those who begin to need the money may be forced out of the market at lower levels. And there's a whole nother lesson just on that. And if you go through those bear market updates, I talked a lot about those type of situations. Remember, quoting Tom McClellan's late mother, Mary McClellan, some people buy when they have money, some people sell when they need money, and others use far more sophisticated methods. And that's paraphrasing her. But if you go to my website, you can see the quotes on that. So a little bit of confliction between the daily Landry light and the weekly Landry light. Now let's take a look at the daily bow tie. As you know, and as I've been saying quite a bit, back in early March, we had a sell signal. And one thing that's kind of interesting is, and this is the signals I prefer when the moving averages come together really quickly, usually over 3 to 4 bars, and form what I call a fulcrum. And it gives it that appearance of a bow tie. And that's kind of the whole idea with this pattern, is to have kind of a tight crossing in the bow tie moving averages. Now, I don't have any official rules other than a preference of 3 to 4 bars. But most of the time, the tighter, the better. Now, this recent little bow tie, we did get the 10 crossing above the 20 exponential. And then now the 20 is trying to get above the 30 exponential. And as I've said in prior weeks, as long as the market stays above those moving averages, the moving averages will eventually cross over. So we could see a bow tie buy signal soon. I'm not as excited about a bow tie now because we're not really coming off of super, super low levels. I know it's like about 2-year lows, but I prefer if we were coming off of like 5-year lows or maybe even 10-year lows. And I think 2009, it was 13-year lows. And that's a lot more impressive signal than one that's coming off of just 1 or 2-year lows. Now, also of interest is the sell signal. The reason that was so significant is that it was coming off of all-time highs. And that is why I was so concerned when we saw these sell signals, because the market was, again, just hitting all-time highs. Now, at all-time highs, and again, we're coming back to the psychology of the market's participants, but think about it. Everybody who has bought the market prior to that high is happy. Now, when the trend begins to turn down, those people are no longer happy because they're beginning to lose money, especially the Johnny-come-latelys who bought very late in the trend. And by the way, they're usually the first to dump their positions, and sometimes they'll take you out with them. And I actually have a pattern called the trend knockout, which we'll talk a little bit about if we have time to get to the chart today. But if not, go in and watch the presentation from several months past where we talked about the trend knockout, one of our earlier shows. And again, you'll get the rules in the slides if you request the slides. Now let's take a look at the weekly bow tie. And we talked about proper order in weeks past, so I just have it already outlined on a chart for you. And that's just the 10 is greater than the 20 and the 20 is greater than the 30. And that's proper order for an uptrend. Now for a downtrend, the 10 is less than the 20 and the 20 is less than 30. So remember, again, this is a weekly chart that we're looking at here. So you could see if all you did for the most part was stay long when the 10 was above the 20 and the 20 was above the 30, in other words, you had an uptrend proper order, you would do pretty good as far as staying on the right side of the market. Now, when those cross over, especially on a weekly basis, and the 10 is less than the 20 and the 20 is less than the 30, then as a general statement, you want to be out of a market or short the market. Now, those moving averages flipping over, especially coming after an all-time high, and especially on a weekly signal, on a weekly basis, could signal a major top in the market. Now, I always think about what Greg Morris said when I do this type of bigger picture analysis and longer term sell signals, is he used to say back in the day when he was running $5 billion or so, he would say, we treat all signals as if it will become the big one. And I guess Elizabeth is implied on that. Now, I've kind of beat the dead horse on this lately, but if you go in and look at the weekly bow ties, and I'll show you a chart here in just 1 second, you'll see that major bear markets have started with a bow tie. In fact, I would venture to say that every major bear market in history started with a weekly bow tie. Now, that does not mean that every weekly bow tie will turn into the mother of all bear markets, but that's why Greg said that they take all signals seriously. So your entry on this would be 25.50. A slightly more aggressive entry would be a little bit higher, and that's if I were trading this signal in and of itself, about 2,700. That's where I would look to go short. And in upcoming shows, if we take out 2,700, then I'll probably be fairly bearish, or continue to be bearish, I should say, or even more bearish, because a lot of times these major bow ties off a weekly chart have turned into bear markets. So 2,700, a little bit more aggressive entry on that. Now here's the chart, and I've beat this chart to death in the past, but what I have here is the major signals coming off of all-time highs on a weekly basis and coming off of many year lows, such as a 5 or a 10-year low. And in the case of 2019, that was a 2009, I should say, that was a 13-year low. But you could see the ugly bear market that started in 2000 and the ugly bear market that started in 2007 both started with weekly bow ties. Now, I just said that every major bear market will have a signal. Well, not every signal will turn into a major bear market. So you can see we did have a sell signal back in 2015. Now, if you go back and watch previous shows, you'll see that even though it doesn't look like a huge deal on the chart, it was a fairly sizable deal. And I think the Russell 2000, after a weekly trigger, lost about 18% from that signal. Now, the media calls a bear market at 20%, for what it's worth. And you can see that last little slide, again in 2018, did have a weekly bow tie sell signal. Now again, it doesn't look that big in this chart, but that was a pretty serious slide. And of course, we're now under a sell signal now, and that's one thing that has me really concerned. Now keep in mind, this is a weekly chart. This could take weeks and weeks and weeks and weeks to unfold. And by the way, go in and look at the shows that I've done prior to this one regarding sell signals such as the TFM 10% system. Now, one thing I've been saying quite a bit is the market will do the most obvious thing in the most unobvious manner. And I first heard that from Linda Rasky. So if you look at this chart here, and this is actually left over from last week, but very important, the most obvious thing for this market to do would be to keep heading lower after it imploded in March. The most unobvious thing would be for it to have a big rally first to suck in a bunch of new traders, to squeeze out a bunch of shorts, present company included, and then turn right back down. The market will do the most obvious and the most unobvious manner. It'll also do, and this is a corollary, and I also heard this from Linda Rasky first, it will also do what it has to do to cause the most amount of pain to the most amount of people. So sucking in people so much so that they mortgage their house to buy stocks. Again, the man on the street as a microcosm. Sucking in these bored traders who are just buying because the market just seems to go up lately. These value players, these newly minted value players. If this thing turns right back down, it could easily have sucked them in and spit them out. And the bad thing about the market is it could be a really, really bad teaching. That's one of the lessons that I kind of beat the dead horse on, as I've said quite a bit. And again, go in and read those bear market updates. But again, being a man on the street kind of guy, in 2018, I bumped into a guy, long story endless, and he's like, man, I'm glad I held on. I wish I would have bought more. So now I'm wondering, did he buy more in this slide that we just had? And is he still holding on and going to keep on holding on no matter what? Unless, of course, the market really, really begins to punish him. Will he eventually throw in the towel? Now, again, although I do think we had the potential to roll back over, as usual, I will believe in what I see and not in what I believe. So check back often. And again, signals will provide clues. Use your charts. As usual, take things one day at a time. And keep in mind, I'm setup driven. I haven't seen any long side setups I've liked very much lately. I saw Zoom a while back. I had it on my watch list. But I decided, the published watch list, the Landry list that I publish daily, but I decided that it wasn't worth the risk to take. Now, of course, it's worked out nicely. That's just trading. You have to be willing to sometimes walk away from a setup if it doesn't fit all your criteria. Now, last few weeks we've been talking about 12+1 trading rules. I'm going to start off with the +1 this week. We're supposed to pick up on number 9, but let's start off with the +1. The +1 is the battle is within. And the Pogo comic comes to mind. We have met the enemy, and he is us. Now, I'm just going to scratch the surface a little bit today on trading psychology. It is something that I have spent countless hours researching. I think I'm a pretty good test subject for that, you know, going in like, why do I feel this way? And then I study psychology and a little neurology, and then I begin to learn how we're not made to trade, why I feel certain ways, why I have this confirmation bias built in, and how I have to work hard to play devil's advocate, especially when I have a very strong feeling, such as now in the market. So we're just going to scratch the surface today. Keep in mind that learning how to trade isn't hard. I could show you some very simple things. In fact, I've shown you some very simple things. A trend knockout is one of the simplest patterns in the world. Bow ties have struck a chord with a lot of people because they're easy to recognize, okay? So learning the process isn't hard. Actually trading is. And as I often say, I've never met an unsuccessful paper trader. Now, as one of my colleagues pointed out, you've been saying that for 20-something years, but nowadays you have the simulated trading. So I would imagine that sooner or later you're going to bump into an unsuccessful paper trader. And that might be true, but what I've seen so far is the people who do the simulated trading actually, given enough time and given time to learn and make sure they're doing things correctly. But most of them, from what I've seen so far, in fact, I haven't met an unsuccessful one yet. And the reason is because you don't have your mortgage on the line. You're not trading with the written money. The money has no meaning to you. Once that money is attached to meaning, once you begin to mentally monetize your trades, the trading becomes a hell of a lot tougher. Now, one thing I talk a lot about is you have to get the reps in. You have to build the muscle. You have to do your analysis, put together your trading plan, actually trade that plan. And then probably the most important thing you can do, in addition to, of course, you know, garbage in, garbage out, make sure you have the best setup to begin with, but probably the best thing you can do afterwards is to do a post-mortem. Now, I often preach if you are looking at a trade and you think, what the hell was I thinking? That's okay. That means you're getting better. You'll still do this 10 years or 20 years or even 30 years into the process, but you'll find yourself doing that less and less. The other thing that you'll do when you start to reach a true enlightenment is you'll look back at a trade and say, you know what? If I was just seeing that same trade today, even though I lost money, I would take it again. And that's the importance of separating the process from the result. If you follow the proper process, that's key. And Annie Duke has a really good book called Thinking in Bets. I'd recommend you read that. She talks a lot about separating the process from just pure luck. When things go bad, we think it's bad luck. When things go well, we think it's skill. So if you can figure out how to separate luck from skill, write me a letter. But one way to do that is to get the reps in. When you look at a setup again, make sure it's the best setup that you could find. Make sure there's nothing that you think could be even better out there. You have to play a little devil's advocate. One thing that I would strongly urge you do is time travel a little bit. Can you live with yourself if it turns into a loser? Now, I violated that rule today. I placed a trade that I shouldn't have placed. And before I placed it, I said to myself, if this thing turns into a loss, I'm going to be very, very, very angry at myself. And it became a self-fulfilling process. See, what did I tell you? I'm a good subject because I get to study my own psychology in all this. And as mentioned a few seconds ago, you want to plan the trade and you want to trade that plan. Easier said than done, but if you do it, you're going to find, number one, that trading is kind of boring, but you can also find that you're going to do much, much better. And again, money management, money management, money management. And you need to learn a little bit about neurology. About 8 years ago or 7 years ago, I was speaking in San Francisco, and Denise Scholl was there, and she talked about how you can't make any decisions without emotions, even what you want to have for lunch. And a lot of this research also comes from a fellow by the name of Damasio. So you have to realize that you cannot eliminate your emotions. You have to embrace your emotions. And the more I learned about neurology, the easier, not easy, but easier trading has become, because I realized a lot of things that are going on in my head. For instance, recently I just read that when you have all these observations by watching the flickering ticks, a term that Dave Keller used in one of his presentations, you're creating a lot of animosity for yourself because you're lighting up the prefrontal cortex. Now, I don't want to get into a big diatribe about how little I know about neurology, but it's very fascinating, and I learned about that through the investor's brain. So very important to learn a little bit of neurology. You don't have to go crazy, but something like the investor's brain would be a good place to start. And I can give you some other books that I've been working on lately on that too. And the next thing is you have to know yourself. And in doing that, I took a personality test, and I learned a lot about myself in the process. So I strongly urge you do that also. And I learned that from Larry Williams' son, wrote a book, who's also a medical doctor, wrote a really good book on trading psychology. And I recommend you read that too. One of the things he said was to take a personality test. And I found out some interesting things about myself, which I will divulge some of these in future presentations. Also talked a little bit about them in the last bear market update. So again, if you're looking to find me, www.davelandry.com/contact. If you want the slides from this presentation, davelandry.com/StockCharts. Everybody, stay safe and sane while we're going through this mess. Thanks for watching, and may the trend be with you.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.